Have you ever sold a winning stock way too early, just to lock in a small profit? Or maybe you've held onto a losing investment for far too long, hoping it would somehow bounce back. If you've nodded yes to either of these, don't worry, you're not alone. This isn't about being bad with money, it's about being human. Today, we're diving deep into a powerful psychological bias that secretly runs our financial lives: loss aversion. We lines uncover why the pain of losing $100 feels so much worse than the joy of finding $100. And more importantly, how you can use this knowledge to become a smarter, more confident investor. So, what exactly is loss aversion? The concept was first introduced by psychologists Daniel Kahneman and Amos Tversky. They discovered that for most people, the psychological impact of a loss is roughly twice as powerful as the pleasure of an equivalent gain. Let me put it this way. Imagine I offer you a simple coin toss. If it's heads, you win $150. If it's tails, you lose $100. Would you take that bet? Statistically, it's a great deal. The potential gain is bigger than the potential loss. Yet, most people would turn it down. Why? Because the thought of losing that $100 just stings too much. That gut-wrenching feeling, that intense desire to avoid the loss, is loss aversion in action. It's a fundamental part of our human nature, a survival instinct that helped our ancestors avoid danger. Back then, losing your food supply was a much bigger deal than finding some extra berries. That instinct is still wired into our brains today, but in the modern world of finance, it can lead us to make some pretty big mistakes. Let's talk about how this plays out in the real world of investing. One of the most common mistakes driven by loss aversion is something called the disposition effect. This is when investors have a tendency to sell their winning stocks too soon and hold onto their losing stocks for too long. Think about it. When a stock you own goes up, you feel good. But then, loss aversion kicks in. You start to worry, what if it drops back down? I'll lose my gains. So, you sell to lock in that small profit and avoid the potential pain of losing it. You feel relieved, but what often happens? The stock continues to climb, and you miss out on much bigger returns. On the flip side, what happens when a stock goes down? The pain of that loss is intense. Selling it would mean making that loss real, admitting you made a mistake. Our brain hates that. So instead, we hold on, telling ourselves, I'll just wait for it to break even. It has to come back up. This hope is often a trap. We become emotionally attached to getting our money back, and we might hold on to a fundamentally bad investment, watching it sink further and further, instead of cutting our losses and reinvesting that capital into something with actual potential. We're so focused on avoiding the pain of a realized loss that we end up creating an even bigger one. This is a classic example of our emotions overriding logic in financial decision-making. Another way loss aversion messes with us is through risk aversion, after gains and risk-seeking after losses. This sounds complicated, but the idea is simple. Let's say you've had a great year in the market. You've made some solid profits. Your natural tendency, thanks to loss aversion, might be to become overly cautious. You might pull your money out and put it into something super safe, like cash or bonds, because you're terrified of losing the money you've just made. You're playing not to lose, instead of playing to win. This can severely limit your long-term growth. Now, consider the opposite scenario. You've just taken a big loss. What does loss aversion do now? It can actually make you take on more risk. You might feel desperate to make back what you lost. This can lead to reckless decisions, like betting big on a highly speculative stock or making a risky trade you haven't properly researched. You're trying to quickly erase the pain of the loss, but in doing so, you're gambling, not investing. It's like a poker player on a losing streak who starts making bigger and wilder baits to get back to even. This is a dangerous path that can quickly spiral out of control. It's our brain's flawed attempt to fix a painful situation, often making it much worse. So, if our brains are hardwired to make these mistakes, are we doomed? Absolutely not. The first and most important step is awareness. Just by understanding what loss aversion is and how it affects you, you've already won half the battle. You can start to recognize when your decisions are being driven by fear rather than by facts and strategy. Once you have that awareness, the next step is to create a system that takes your emotions out of the equation as much as possible. And the best way to do that is to have a solid investment plan. Before you ever buy a single stock or fund, You need to define your goals, your time horizon, and your risk tolerance. Write it down. Why are you investing? For retirement in 30 years. For a house down payment in 5 years. Knowing your why gives you a North Star to follow when market volatility makes you feel scared or greedy. Part of this plan should include clear rules for when you will buy and when you will sell. For example, instead of selling a winner just because you're scared, you could have a rule to only sell if the company's fundamentals have changed for the worse or if the stock has become an outsized portion of your portfolio. For losers, set a stop loss. This is a predetermined price at which you will automatically sell a stock to limit your losses. For example, you might decide to sell any stock that drops 15% from your purchase price. This automates the decision, taking your emotional, loss-averse brain out of the driver's seat. It turns a painful, emotional decision into a simple, mechanical action based on your preset rules. Another incredibly powerful tool to combat loss aversion is diversification. The old saying, "Do and put all your eggs in one basket," is the best financial advice for a reason. When your entire net worth is tied up in one or two stocks, every little dip will feel like a catastrophe. Your loss aversion will be on high alert, 24/7. But if your money is spread across many different stocks, bonds, and asset classes, a loss in one area will be cushioned by gains in another. This smooths out the ride. It lowers the overall volatility of your portfolio, which in turn helps to calm your nerves and allows you to stay invested for the long term, which is where real wealth is built. Let's also talk about perspective. It's crucial to reframe how you think about losses. In investing, short-term losses are not just possible. They are inevitable. They are the price of admission for long-term gains. No one, not even the greatest investors in history, has a perfect track record. They all have investments that lose money. The key is that their winners far outweigh their losers over time. Instead of viewing a loss as a personal failure, see it as a data point. What can you learn from it? Did you misjudge the company? Did you buy at a bad time? Every mistake is a lesson that makes you a better investor. Embrace the learning process instead of fearing the red numbers on your screen. A practical tip is to check your portfolio less frequently. If you're constantly watching the daily fluctuations of the market, you're just feeding your loss aversion. It's an emotional roller coaster. Instead, commit to checking your portfolio on a set schedule, maybe once a month or once a quarter. This gives your investments time to grow and prevents you from making rash decisions based on short-term market noise. Focus on the long-term trend, not the daily blips. To sum it all up, loss aversion is a powerful, primal instinct that makes us fear losses more than we value gains. It can lead to costly mistakes like selling winners too early, holding losers too long, and making reckless baits to recover losses. But you are not a slave to this instinct. By understanding it, creating a solid investment plan with clear buy and sell rules, diversifying your assets, reframing your perspective on losses, and checking your portfolio less often, you can tame the beast of loss aversion. You can shift from being an emotional reactor to a disciplined, strategic investor. It's about building a system that protects you from your own worst instincts and allows you to make rational decisions that will serve you well on your journey to financial freedom. Thank you so much for watching. If you found this helpful in understanding your own money psychology, please hit that like button and subscribe for more content on becoming a smarter investor. Let me know in the comments if you've ever caught yourself falling into the loss aversion trap. I'd love to hear your story. See you in the next video.